It arrives in your mailbox on a Tuesday, a white envelope. The return address is Kansas City, Missouri. The logo in the upper left corner is small and official and requires no introduction. You know what it is before you open it. What happens next? The phone calls, the letters, the outcomes, the years of your life this consumes or does not consume has almost nothing to do with what you actually owe. It has everything to do with what you can afford to spend proving it. Level 1. You file with a free software tool and pray. You make $31,000 a year. You work for a logistics company. Your taxes are not complicated. One W-2, one employer, no investments, no property, no dependents this year because the custody arrangement changed and you are not sure which parent gets to claim the child, and neither are you. You use the free filing tool the IRS advertises on its website. You answer the questions. You submit. You receive a confirmation number and a refund estimate of $840 that feels, for approximately 1 week, like found money. Then the letter arrives. The IRS has flagged your return. The issue is the dependent claim. Your ex-partner also claimed the child. The system has identified a conflict and frozen both refunds pending resolution. You call the IRS helpline. The average hold time this year is 27 minutes. Today, it is 41. When someone answers, they are not unkind, but they are reading from a protocol, and the protocol tells them to mail you a form. The form is called an 886 HDEP. It requires documentation proving your right to claim the dependent. Birth certificate, school records, medical records, proof of residency. You gather the documents over 2 weeks because the school records require a formal request and the medical records require a release form and your printer ran out of ink. You mail everything certified. You wait. The IRS processes correspondence at a rate that has been chronically backlogged for years. Your response will be reviewed in approximately 16 weeks. Your refund is frozen until then. You needed that $840 in February. It arrives, if it arrives correctly, in June. You did nothing wrong. The system processed your situation through its standard mechanism, and the standard mechanism does not distinguish between a fraudulent duplicate claim and an honest dispute between two parents who are both trying to do the right thing through the wrong paperwork. You are not a priority. You are a case in a queue. The queue is very long. Level 2. A small mistake becomes a large problem. You are self-employed, freelance graphic design, $58,000 last year across 11 clients. You paid your quarterly estimated taxes, mostly on time, mostly the right amounts. You filed your Schedule C yourself using a software program that asked you questions and seemed confident in its answers. The IRS disagrees with one of your deductions. The home office deduction, $4,200, representing the square footage of the room where you work, divided by the total square footage of your apartment. The calculation was correct. The documentation was not. You did not have a floor plan. You did not have photographs. You did not have a written record of the room being used exclusively for business. The notice arrives 14 months after you filed. It proposes an adjustment of $4,200 in disallowed deductions, which generates a tax liability of $924 plus interest and a potential accuracy penalty of 20%. You call a local CPA. Their consultation fee is $200 an hour. They review your notice, confirm the issue, and tell you that you probably have a reasonable case, but that building it will require 2 to 3 hours of their time, plus your time gathering records that may or may not be sufficient. You do the math. Fighting costs $600 minimum in professional fees for a dispute worth $924. And if you lose, you owe the $924, plus penalties, plus interest, plus the $600. Most people at this level do not fight. They pay. Not because they are wrong, because the economics of being right do not justify the cost of proving it. The IRS collected money from you that you may not have legally owed, and the system was structured in a way that made accepting the loss more rational than contesting it. That is not an accident. That is an outcome. Level 3. You get an accountant and the world shifts slightly. Your income is $140,000. You have a salary, some freelance income, a brokerage account that generated dividends, and one sale that produced a capital gain you almost forgot about. Your taxes are no longer a form you can fill out alone. You hire a CPA, not a tax preparation service, an actual certified public accountant who you see once a year in February and email occasionally when something financial happens that you are not sure how to categorize. The difference is immediate and structural. They find deductions you did not know existed, a home office you had not claimed correctly, a retirement contribution limit you had not maximized, a business expense buried in your freelance work that you had been paying with post-tax dollars for 2 years. Your refund this year is $2,400 more than last year. The CPA cost $800. The net is $1,600 in your favor, plus the value of not having filed something incorrectly. When the IRS sends a notice, and the IRS sends a notice eventually, to almost everyone, your CPA handles it. You forward the envelope, unopened. They respond. The matter resolves. You are aware it happened in the way you are aware that your car had a minor repair. It was addressed. Life continued. The IRS interacts with you at this level through your representative. You are no longer on hold for 41 minutes. Your CPA has a practitioner priority service number, a separate IRS line for tax professionals that has shorter hold times and reaches agents with more authority. The same agency, the same rules, a different door. Level 4. Tax planning replaces tax filing. Your income crosses $300,000. The nature of your relationship with taxes changes category. You are no longer filing. You are planning. Your CPA has been replaced or supplemented by a tax strategist. The distinction matters. A CPA files what happened. A tax strategist shapes what will happen, so that what gets filed is the most favorable legal version of your year. Conversations begin in October, not February. You discuss income timing, whether to accelerate revenue into this year or defer it into next depending on projected rate changes. Whether to harvest losses in the brokerage account to offset gains elsewhere, whether the charitable contribution you were planning makes more sense as a direct donation or through a donor-advised fund that gives you the deduction now and the distribution flexibility later. These are legal strategies. Every one of them is written into the tax code. They are available, in theory, to anyone. In practice, they require time, expertise, and liquidity to execute, which means they are available to the people who already have enough money to benefit from them. Your effective tax rate drops meaningfully from what it would have been without planning, not through evasion, through navigation. The code has always had these pathways. You now have someone whose job is to walk them with you. The IRS does not audit you more at this level than at level 2. Statistically, audit rates for people earning $200,000 to $500,000 are not dramatically higher than for moderate earners. The audit rates that spike are at the very bottom and the very top. In the middle, you exist largely in a gap. Level 5. The structure of your income changes. You earn $800,000. But earn is no longer quite the right word. Your compensation arrives through a salary, yes, but also through carried interest, partnership distributions, S-corporation income, and long-term capital gains from equity that vested over 4 years and was sold this year at a rate of 20% rather than the 37% that would apply to ordinary income. This is not an accident. The structure of your compensation was designed by your employer and their counsel to deliver money to you in the form that is taxed least aggressively. You did not design it. You benefited from the design. You now have a team. Your CPA handles compliance. Your tax attorney reviews structures and advises on anything with legal complexity. Your financial advisor coordinates investment decisions with tax implications. They talk to each other, quarterly, sometimes monthly. The left hand knows what the right hand is doing because not coordinating is expensive. Your entity structure has been reviewed. You have an S corporation for your consulting work. You have a family limited partnership that holds real estate. You have a retirement plan that allows contributions far beyond the standard 401k limit. Each structure was created for a legitimate business purpose and produces, as a secondary effect, a meaningfully lower tax liability than you would carry as a simple W-2 employee earning the same total compensation. The IRS has not contacted you in 6 years. If they did, your attorney would respond the same day. Level 6. The audit is a different experience. Your net worth is above $10 million. The IRS has selected your return for examination. This is not a letter. It is a notice of audit, and it is addressed to your tax attorney, not to you, because your tax attorney's address is the address of record for your returns. You learn about it in a phone call that lasts 4 minutes. Your attorney tells you the scope, the timeline, and what they need from you, which is very little, and what they will handle, which is nearly everything. The audit is conducted through correspondence and scheduled meetings between your legal team and the IRS examination agent. You attend one meeting. You answer 3 questions. Your attorney answers the rest, or redirects them, or notes that the question exceeds the scope of the examination as defined by the initial notice. Your documentation is complete because your team maintains documentation continuously, not in response to an audit, but as a standard operating procedure. The expense logs are organized. The entity records are current. The appraisals on the real estate are dated and signed. There is no scrambling. There is production. The audit closes 14 months later with a minor adjustment. $18,000 in additional tax on a matter your attorney partially contested and partially conceded as a strategic decision. The adjustment is paid without drama. The relationship with the IRS returns to its default state, which is managed distance. You did not experience this audit. Your team did. Level 7. The IRS builds a team to examine yours. Above $100 million, the IRS assigns you to the Global High Wealth Program. This is not a standard audit division. It is a specialized unit created specifically to examine the returns of individuals with substantial assets and complex structures, pass-through entities, foreign holdings, private foundations, trust arrangements spanning multiple generations. The agents assigned to your examination are not generalists. They are specialists, trained to understand the kind of layered structures that exist at this level of wealth. They examine not just your individual return, but the returns of every entity connected to you. The partnership, the S corporation, the family office, the foundation. You have known this examination was possible. Your team has prepared for it continuously. The structures in place were designed with this scrutiny in mind, which means they were designed to withstand it. Your legal team for this examination includes a former IRS senior attorney who now works in private practice, 2 tax litigators from a firm that specializes in high net worth examinations, and a forensic accountant who can reconstruct the logic of any transaction from the documentation backward. The examination takes 2 years. It costs $900,000 in professional fees. It closes with adjustments your team partially concedes and partially defeats in appeals. The net additional tax is $2.1 million on a structure that saved considerably more than that over the period under examination. The math still worked. The team made sure of it. Level 8. You help design the rules being applied to you. At the highest concentrations of wealth, the relationship with the IRS becomes something that operates less like enforcement and more like negotiation between 2 sophisticated parties who both understand that the rules have edges and that the edges are where everything interesting happens. The tax code was not written by the IRS. It was written by Congress, over decades, through a legislative process in which your interests, at this level, have been actively represented. The carried interest provision that taxes your fund manager's compensation at capital gains rates rather than ordinary income rates did not appear by accident. It was argued for, lobbied for, and preserved through multiple administrations by people whose professional purpose was representing the financial interests of the people who benefit from it. Your estate plan exists inside a framework of provisions: grantor retained annuity trusts, intentionally defective grantor trusts, family limited partnerships, qualified opportunity zone investments that were not available to the public until they were created, and were not created without extensive input from the advisors who serve clients at this level. You are not breaking the rules. You are operating inside rules that were shaped in part by the gravitational pull of capital at your scale on the legislative process that writes them. The IRS enforces what Congress writes. Congress writes, in part, what concentrated wealth finds it useful to have written. Somewhere, a freelance designer is deciding whether $600 in CPA fees is worth spending to contest a $924 adjustment she probably shouldn't owe. She will likely pay it. Not because she is wrong, because the system has always known that being right and being able to prove it are 2 different things. And the distance between those 2 things has always been measured in money.